Two people apply for the exact same mortgage, same job, income, and down payment. Person A gets approved at 4.5% interest, paying $2,500 a month. Person B gets approved at 6.5%, paying over $3,150 a month. That extra $650 a month doesn't seem disastrous. But over 30 years, Person B pays over $234,000 more for the exact same house. $250,000 vanished. The difference wasn't income or savings. It was one three-digit number banks have turned into a multi-billion-dollar profit machine. The secret to controlling it is something they actively count on you never discovering. You know the feeling, that knot in your stomach applying for a loan or credit card. You fill out forms, provide income, then hit the credit check box. You hold your breath, click submit, and wait for the verdict. Approved, denied. Or worse, approved with an interest rate that feels like punishment. A 22% credit card rate, a 9% car loan rate. These aren't just numbers, they're a tax. A tax you pay for not knowing the game's rules. Banks advise patience, pay bills on time, keep balances low. Wait. For years. While you wait, you pay them thousands in extra interest. They profit from your patience, from your lack of knowledge. Traditional advice isn't wrong, just incomplete. It's like telling someone to get rich saving $5 a week on coffee. Technically true, but too slow to be useful. Today, we pull back the curtain on the single most powerful mechanism for rapidly building your credit score. Most consumers never discover this mechanism, written directly into the financial system's code. It's not a hack or gimmick, but a system feature banks understand perfectly and are happy if you don't. We'll break this down into 3 simple rules. Follow them and control your score faster than you thought possible. Ignore them and you'll stay on the slow path, paying the high interest tax for years. Let's start with rule number 1. Your credit score is not for you. This is the most important mindset shift. Your score isn't a financial report card grade or a measure of your worth. It's simply a risk assessment tool for lenders. Its job, predict your likelihood of repaying a loan within 90 days. Higher score, lower perceived risk. Lower risk, less interest they charge. The system is designed to make banks money. They're not your friend or partner. They're a business selling debt. Their goal is to sell it at the highest price you'll pay. A low credit score justifies charging you more. Let's look at how this number is calculated. It boils down to 5 FICO factors. Payment history, 35%. Do you pay bills on time? Amounts owed, credit utilization, 30%. How much available credit you use? New credit, 10%. Don't apply for too much at once. Credit mix, 10%. Lenders like to see different debt types, card, auto loan. That's 85% of your score, and the part everyone talks about. Pay bills, keep balances low, don't open too many cards. This is the slow, grinding advice that takes years for real impact. The real key to accelerating progress lies in that last forgotten 15%, bringing us to the biggest trap. Rule number 2. You must escape the 15-year deception. The final 15% of your FICO score is length of credit history, the average age of all your accounts. Older accounts are better because a long track record predicts future responsibility. A bank sees a 15-year-old card holder as a safe bet, a 1-year-old account holder as a risk. Here's the deception. Conventional advice says start building credit ASAP with a student or secured card. Fine. But if you open your first card at 22, your average age is 1 year. In 5 years, it's 5. To reach the excellent credit tier, 10 to 15 plus years average account age, you literally must wait. A decade. A decade and a half. During this time, your score is held back. Even with perfect payment history and zero debt, a young credit file means higher risk, meaning you pay more. A 25-year-old buying a car has at best a 7-year history if they started at 18, likely only 3 or 4. This automatically ceilings their score. Banks design the system this way, forcing young borrowers, those needing affordable credit most, to pay the highest rates. For years, this was accepted. You had to slowly build history. But what if you could skip the line? What if you could instantly import decades of perfect credit history onto your file? That's not a fantasy. It's a built-in system feature. And that brings us to rule number 3. Use the authorized user accelerator. This mechanism, often called a loophole, is the single fastest, legal, and legitimate way to add years, even decades, of credit history to your file, sometimes in 30 to 60 days. Here's how. When a primary credit card holder adds someone as an authorized user, they grant permission to use the card. But behind the scenes, most major banks, like Chase, Bank of America, Capital One, report the entire history of that credit card account to the authorized user's credit file. To reiterate, if your parent opened a credit card in 1995, never missed a payment, keeps a low balance, and adds you as an authorized user today, that entire 29-year perfect payment history can instantly appear on your credit report. Your average age of accounts won't just increase, it can skyrocket. Let's use a real-world example. Sarah and Tom, both 28, earn $70,000 a year and have perfect payment histories on 2 credit cards opened at 23. Their credit files are 5 years old and scores are stuck around 680, approved but with higher interest rates. They both want to buy a house. Tom follows the conventional path, waiting for his score to slowly creep to 700 in 2 years. Sarah learns about the authorized user strategy. Her mother has a 25-year-old visa with perfect payments, a $20,000 limit, and only $1,000 used, 5% utilization. Sarah's mom adds her as an authorized user, not even giving her the physical card, just adding her name to the account. 30 days later, that 25-year-old account, with its perfect history and low utilization, appears on Sarah's credit report. Instantly, her overall credit utilization drops dramatically. Total available credit jumped by $20,000, boosting the amounts owed portion of her score. The real magic is her average age of accounts. With 2 5-year-old accounts, her average was 5 years. Now, with 3 accounts, 2 5-year-olds, 1 25-year-old, her new average is over 11 years. Her credit score doesn't creep, it jumps. A 50, 80, even 100-point jump is common. Sarah's score goes from 680 to 760 in about 2 months. When Sarah and Tom apply for that $400,000 mortgage, the bank sees 2 very different profiles. Tom, with his 680 score, is a moderate risk. He's offered a 6% loan. His monthly payment is $3,800. Over 30 years, he pays over $577,000 in interest. Sarah, with her 760 score, is a prime, low-risk borrower. She gets the same loan at 4.5%. Her monthly payment is $3,200. Over 30 years, she pays $416,000 in interest. This strategy saved Sarah $161,000. That's the power of this mechanism. Not tricking the system, but using its rules to your advantage, just like banks do. But wait, before calling every relative, understand this isn't a silver bullet. Done incorrectly, it carries serious risks, potentially damaging your credit, and worse, the credit of your helper. This brings us to a critical 4th step. This is the safety checklist. Verify these 5 checkpoints before considering this strategy. Miss one and walk away. Checkpoint 1. Primary account holder's profile. The person adding you must have excellent credit, non-negotiable. This means a score over 750, perfect payment history, 0 late payments, and a long card history. At least 5 years, but 15 to 20 years is gold standard. Checkpoint 2, low credit utilization. The card must have a low balance relative to its limit, ideally under 10%. If a 30-year-old card carries a $15,000 balance on a $20,000 limit, being added will destroy your credit score, as that high utilization copies to your report. This is a common, devastating mistake. Checkpoint 3, the bank must report. Crucial. Not all banks report authorized user history, and some report only partial info. Confirm the bank reports the account's full history. Major issuers like Chase, Bank of America, Discover, and Capital One are generally reliable. American Express is less effective, often backdating history only to your addition date, not the card's original opening. An online search for your bank's policy is mandatory. Checkpoint 4, the agreement. This is about trust. The primary account holder is legally responsible for any charges. The safest way is to be added as an authorized user without receiving the physical card. You inherit the history, not use the account, protecting the primary holder from bill risk. Checkpoint 5, the exit plan. Agree on an exit plan. If the primary holder's financial situation changes, job loss, high balance, you must be removed immediately. Monitor your credit report and be ready to be taken off to protect your score. This is a partnership, and communication is key. If you check all 5 boxes, you've found a powerful, safe way to accelerate your credit journey. But what if you can't? What if you lack a family member with a pristine 20-year-old credit card? Are you stuck on the slow path forever? Absolutely not. This brings us to our final rule. Rule number 5, build your own foundation. The authorized user strategy is an accelerator, like a turbo booster, but you still need the car. If this strategy isn't accessible, your path isn't blocked. It's the conventional path, but you can walk it smarter and faster. First, if you have damaged or no credit, get a secured credit card. You provide a security deposit, usually a few $100s, which becomes your credit limit. This eliminates bank risk, making approval easy. Use it for a small recurring monthly purchase, for Netflix, then set up automatic full payments. After 6 to 12 months of perfect payments, your score increases, often graduating to an unsecured card, returning your deposit. Second, consider a credit builder loan from many credit unions. It works in reverse. You don't get money up front. You make small monthly payments, for example, $50 a month for a year, into a locked savings account. The credit union reports these on-time payments. At the term's end, the account unlocks and you get your money back, a forced savings plan that builds positive payment history. Third, with these foundational accounts, practice flawless credit habits. Pay every bill on time, every time. 35% of your score, the biggest piece. Keep credit card balances low. Never use more than 30% of your limit, and ideally stay under 10%. This path is slower, taking a few years, but it's a guaranteed route to a good credit score if disciplined. You can build a 750+ score from scratch. It just takes time. The authorized user strategy is a shortcut, but the destination is the same. The financial world is a game with rules, and for too long, banks held the full rulebook. They benefit when you see your credit score as a mysterious number that happens to you. They lose leverage when you see it as a system you can influence, a mechanism you control. That $250,000 in extra interest, the difference between person A and person B, isn't just money. It's freedom, options, the ability to invest for your future, take a vacation debt-free, and feel security instead of dread. Your future self will either thank you for taking control or wonder what happened to all that money paid out as a hidden tax. The choice starts today. The next time you check your credit score, you'll see a number you control, or one that controls you. If this video changed how you think about your credit, subscribe for more strategies